Welcome to the penultimate chapter of our odyssey into the world of the MACD. We've learned the what, the how, and the when. We've explored strategies from the most basic to the most advanced. But a true master doesn't just know how to use a tool, they understand why it was designed that way. They know its DNA, its genetics. Today we're putting on our lab coats. We're going to ask the questions few people ask. Why did Gerald Appel use exponential moving averages and not simple ones? Are the numbers 12, 26, and 9 sacred and unchangeable? Is there a forgotten cousin of the MACD that might be even better in certain situations? And finally, when should we, philosophically, accept that the MACD is completely useless? This is the video that deconstructs the myths and takes you to the conceptual core of the indicator. Prepare for a journey into the mind of its creator and the physics of the market. Gerald Appel had options. He could have based his indicator on simple moving averages, SMAs, which are easier to calculate. But he deliberately chose exponential moving averages, EMAs. This was not a casual decision. It's the key to the entire system. To understand why, we must understand the tyranny of the past of the SMA. A 26-day simple moving average gives the exact same importance to today's price as it does to the price from 26 days ago. It's perfectly democratic, but in the fast-moving world of markets, it's a dinosaur. It's slow to react to crucial new information. The EMA, on the other hand, operates on the principle of the relevance of now. It gives an exponentially greater weight to the most recent prices. Today's price matters far more than yesterday's, and yesterday's matters far more than last week's. What is the expert implication of this? The MACD is genetically engineered to be a momentum indicator that prioritizes new information. It's a system that says, sure, I care about the general trend represented by the 26 EMA, but I'm obsessed with what's happening right now, the 12 EMA. This choice makes it much more sensitive and faster than any SMA-based indicator. But this sensitivity is a double-edged sword. It allows it to capture shifts in momentum quickly, but it also makes it more prone to noise and false signals if not filtered with the techniques we've already learned. Almost every trader in the world uses the standard 12, 26, 9 settings. But are these numbers magical? The answer is no. They are a historical legacy. They come from an era when the trading week on the New York Stock Exchange was 6 days long. So 12 days was roughly 2 weeks, 26 days was roughly a month, and 9 days was a week and a half. They're a good starting point, but not a universal law. An advanced analyst knows how to adapt or calibrate the parameters to the unique character of the asset they trade and its time frame. For day trading or scalping on 5 or 15-minute charts, the standard parameters are desperately slow. A high-frequency trader might use a setting like 5-35-5. The 5 reacts almost instantly to price changes. The 35 establishes a more stable intraday trend, and the signal line at 5 smooths just enough to avoid total chaos. For swing trading or long-term investing, on weekly charts, 12-26-9 can be too sensitive, generating noise from minor corrections. A long-term investor might prefer a setting based on the Fibonacci sequence, like 21-55-8. This filters out the market's minor jitters and focuses only on the major turns in the primary trend. But herein lies an immense danger: curve fitting or over-optimization. It's very easy to look at past data and find the perfect setting that would have generated flawless signals. The true art isn't finding past perfection, but a setting that is robust and continues to work in the future. The golden rule is, don't seek perfection, seek robustness. In most cases, the standard 12-26-9 is more than sufficient when combined with other techniques.
The MACD has a fundamental problem, a birth defect that few discuss. It's not comparable across different assets. Think about it. An MACD value of plus 2 points on a stock that's worth $10 is a massive move. But the same plus 2-point value on a $500 stock is just background noise. The MACD gives you an absolute value, not a relative one. This is where its smarter but often forgotten cousin comes into play, the PPO, or Percentage Price Oscillator. The idea is exactly the same, but with one crucial difference. The result is expressed as a percentage of the price, not as an absolute value. This normalizes the indicator. Why is this an expert's tool? Because it allows you to do something the MACD cannot. Compare the relative momentum of different assets in a mathematically sound way. You can put Apple's chart next to Google's and use the PPO to objectively determine which of the two has stronger bullish momentum in percentage terms. For a portfolio manager who needs to decide where to allocate capital, the PPO is vastly superior to the MACD.
A true expert doesn't just know how to use a tool, they know its exact breaking points. When is the MACD useless? 1. Black swan events and flash crashes. During a sudden extreme panic or euphoria, the MACD is irrelevant. It's a system based on averages and cannot process an event that is completely outside the statistical norm. Looking at the MACD during a market crash is like looking at your car's broken speedometer as you're falling off a cliff. It gives you no useful information. 2. Low liquidity assets. On a thinly traded stock or crypto, prices can jump around erratically without real volume behind them. The MACD will generate chaotic and meaningless signals because the price data itself doesn't reflect true mass psychology, but rather isolated transactions. 3. The trend followers paradigm. Finally, you must philosophically accept what the MACD is, a trend-following system. This means it will always make you buy later than the bottom and sell later than the top. Its goal is not to nail the exact turning points, but to capture the meat of the move, the large middle chunk. Trying to use it to predict the high or low of the day with pinpoint accuracy is a misconception that only leads to frustration. Today, we've gone beyond the lines and bars. We've explored the MACD's genetics, challenged its parameters, met its smarter cousin, the PPO, and clearly defined its philosophical limits. You now understand the why behind the what. But we still have one last level of depth to go, the final layer. In our last video of this series, we will transcend trading. We'll look at the MACD from the perspective of a signal engineer, a quantitative analyst, and a market psychologist. We'll discover why the MACD is, in essence, a mathematical illusion that works, and why the purest quants despise it. It will be the conclusion that ties everything we've learned together. If this deep dive into the MACD's DNA has given you a new appreciation for its design, show it with a like. To make sure you don't miss the grand finale of this saga, subscribe and hit the bell. And now, a question for the thinkers in the comments. Would you dare to experiment with the MACD's parameters, or do you prefer to trust the standard 12-26-9? And why? We are Money Talks US. It's been fascinating to explore these dimensions with you. I'll see you for the final revelation.